I think this might be one of the first special guests that we have on Cashflow Chronicles. Obviously, today we will be getting to SLG, but also we got into a conversation. If you guys didn't see this, I was also on Finance Junkies today for the first time. And with that, we ended up somehow talking a little bit about Verizon, and Steve got all fired up. And so Chris also is somebody that is in Verizon. I've also owned Verizon in the past, which I sold in the $58 or $60 range. And so I'm curious because it's been a couple of years since that point that I've divested out of Verizon. Curious what it's looking like. And so I'm excited to kind of kick off with that. And then we'll eventually get into SLG. I personally thought SLG had pretty good earnings, but it is what it is. But I'll leave it to you guys. And then also in the background, I will be adding Steven's description or my description below Steven's Twitter. So if you guys are, make sure to follow him. He does a lot of articles on Seeking Alpha and just an all around good looking guy. Check him out. Look at him right there with the glasses and everything.
Yeah. I think right now Verizon is one of the best opportunities in the market, considering where they're headed and how much they can actually capitalize on this transition to 5G. Like, I have 5G home internet. It's from T-Mobile, but it is amazing. Like the level of complexity needed to get started is so low. The complexity needed to get it up and running, like from the business standpoint, is super low. So I think this is one of those times where we're going to see an incremental shift away from like cable TV into 5G home internet. It's super speedy, and the cost is way better than cable. I know people that are paying like $120, $150 for cable internet, and it's just like, why? You know. And now Verizon has they bought a lot of something called Spectrum over the last like couple of years, and now they're finally going to be able to monetize a lot of that spectrum. So a lot of the services, like a lot of people are like, well, I don't have home 5G like near me, that's not available. It's going to start making its way into the availability pool for a lot of people. A lot of that was primarily because, you know, you had to do something called spectrum clearance so that, you know, the like signals don't interfere with each other. And so the FCC had this giant auction, and Verizon came away with a large part of that spectrum. So it'll be interesting to see where they end up going, but I think they're going to do very well. You know, I know Steven's got this whole presentation on Verizon, so I'd love to see that. And then, you know,
I'll stop doing the read stuff, and I'll do it the last two columns live.
Okay.
But I'm going to echo what Chris said about Verizon. It's past 10 p.m. Still drinking coffee as I'm
Smart man.
So Chris alluded to something on the Finance Junkie stream. Yes, I understand. Let's proceed to share this.
Can you make it, one screen, Matt? There you go.
Sorry.
So I'm going to increase it. Is that good? You want me to go one more time?
No, I think that's good. I could see it, but there we go. That's better. That's better.
All right. I just want to see what it looks like one more time for the viewers.
Okay. That looks even better.
Okay.
It's beautiful.
All right.
Yeah.
So Chris knows, and I'm sure Matt knows how I look at things by now. So I'm very numbers driven. So Verizon and AT&T are both tremendously undervalued, in my opinion. But Verizon is very interesting here as well. So they have not reported yet. So I'm using the trailing 12-month numbers. They're trading at just under 9 times their free cash flow. You show me a business that's generating $15 billion a year in free cash flow, and you're paying high single digits. That is crazy, considering T-Mobile generating just over $4 billion, and they're trading at 37 times. Now, I looked at the forward EPS for each of the companies for 2023, 2024, and 2025. Verizon is trading at under 7 times their forward PE for the next 3 years. Now, the market, I believe, doesn't necessarily like Verizon right now because of their debt profile and because there's not a lot of earnings growth on the horizon. people are misunderstanding the debt profile, and I actually broke everything down. And what Chris had said before was 100% true, that Verizon is trading at a lower PE than their dividend yield. So Verizon's paying $2.66 dividend. They just increased it. It's an 8.5% yield, and it's less than 60% of their forward EPS on 2023. So super high yield, great payout ratio, leaving a lot of room for debt. Now,
one thing, Stephen,
go
and
ahead.
I was listening to the last conference call. They are so committed to keeping that dividend exactly where it is. Like one of the
They
things that
just
they're
increased it 2
prioritizing
weeks
is that.
ago by
Yeah,
4 or 5 cents.
Yep. So that's the thing. When businesses project out that they're, going to maintain their dividend, they typically do that. So if they didn't see the forward cash flow in the future, they wouldn't have gone to that length to just say, like, no, one of the priorities that we always are going to have is the dividends. And I think a lot of people are expecting Verizon to cut their dividend when I don't think that's even necessary or a reality.
Yeah, so let's stick on that for a moment. So typically, when a company pays a dividend, it means that they are in a predictable industry with predictable trends, and they have a good handle on their finances, because they have to plan several years out, because that's EPS that is not getting reinvested into the company, that they are now profit sharing with all the shareholders. So Verizon has, I think it's like 18 years of increases. I'd have to look. It's the first number that came to my mind. Very predictable business. Now, keep in mind, less than 57% of their earnings are getting paid in the dividend. Now, people look at Verizon's debt profile and they get shook because they have more debt than AT&T. It's like 140 something billion. Now, normally that would scare me, but I actually look into debt the way you guys do. So the first thing I do is Verizon has 4.2 billion shares, pay a dividend of 266. Their annual dividend obligation is $11.2 billion. Their earnings from operations in the TTM is just over $21 billion. So you have $9.85 billion in retained earnings. Now, I looked at they also have $4.92 billion cash on hand. So I looked at their debt obligations. This is not updated yet. This is from the beginning of 2023. So I'm going to put that disclaimer out there because for some reason they haven't updated on their quarterlies, but it was in the annual report. So with giving myself some rope, they had 9.3 billion in debt obligations this year. Next year's big with 16.5 billion. Then you got 8.7, 8.3, and 6.9 billion. Total of roughly 50 billion in debt over the next 5 years. So when you look at this, so what I did is their debt obligation per year, what the retained earnings are, what their retained earnings are after allocating it toward the debt, and then with their cash on hand, what they have left over. So this year, if they used all their retained earnings after paying the dividend toward the debt obligation, they'd still have 572 million left. Yeah, that to their cash on hand, they're at 5.49 billion. Next year is a huge year of debt, 16.52 billion. They can absolutely buy some of that back this year because they have enough cash on hand, probably buy it at a discount, or refinance some of it at a higher rate going into the future. If they didn't, they could issue bonds, pay it down. Next year's the only bad year. After that, you have enough. If you look at the 5 years, if they played a financial manipulation, so to speak, game of when to pay stuff off, they could finish the next 5 years eliminating 50 billion in debt and still having 4.4 billion in cash, assuming that their retained earnings, which looks pretty steady over the past several years, stays the same, and their predictable business stays predictable. Like, they're not in a situation where debt is an issue. It can be serviced, and they're in a capital intensive business, and nobody's getting rid of cell phones.
There are a couple of things to add to that. If you look at Verizon in terms of just overall where they are likely to go in a recession, let me just share my screen real quick, Stephen, and then you can have
Yeah,
it
how
back.
do I stop sharing?
I got
It's
it.
fine. I got.
Oh,
You can
on the
keep your
top.
screen. Yeah. Oh, there you go.
So my thesis on Verizon is very simple. Okay. Number one, if you just look at their fixed wireless amount, the number of ads that's happening in fixed wireless is going to be amazing. So they're going to be taking, a good portion of market share because of that. So that's an entirely new business that they're going to be able to monetize. So that will help with some of the growth that's there. And so you can see here right now, they net add about 400,000 people to fixed wireless. And now that they've actually done the clearance on that, they should be actually able to address way more. So if you look at like where Verizon's like C-band is, like how many people that can actually cover, they're actually going to be able to cover by 2024 almost 250 million Americans, like based on populations that have the ability to get on it. So the total addressable market is growing exponentially. Now, one of the things is that they had to spend a lot of money on CapEx over the last 4 or 5 years in order to finance a lot of that spectrum. And also you have to put in the technology to address, to, basically allow for that to happen. So you can see here that their CapEx grew in 2022 and 2023. But the great thing is, even they've mentioned it, is that their CapEx is starting to go down. Right. So that means their free cash flow is going to be growing at a really fast pace. So if you look at like, let me just bring it down here. What they're projecting out, Verizon right now is doing about, next year is projected to do about 19.25 billion in CapEx. And the year after that, in 2025, they're going to do about 17.5. So I think 19.5 is this year. And then next year, which is 2025, 2024, is going to be 17.5. And it's going to stay leveled off at 17.5 for a good amount of time while they're addressing their debt. Now, the one thing that you really got to look into with their debt is that they're an investment grade company, so they don't have to worry about issuing debt at like these crazy rates that other companies might have to, especially if they don't have like a good credit rating. So their credit rating is investment grade, so that helps tremendously. But this is the thing that I really wanted to emphasize. They have stock buybacks that could start happening in 2025. And the weight and the metric that they're using in order to get to the point where they can start buying back shares is that when their net debt adjusted to their EBITDA falls below 2.25%. Right now, well, when this article first came out, this was in 2022 during one of the conferences, it was trading at a 2.8 times their adjusted EBITDA to net debt. So if you go here right now, they break this out in their earnings. Right now, you see that net debt to EBITDA is at 2.6%. What you're saying, Stephen, is all that additional that free cash flow, if that goes towards the debt, that means that their net debt is going to shrink significantly, which means that any additional free cash flow is going to be able to go into their into their EPS growth. So at an EPS right now of about only 6, dude, imagine that. You have a company that's buying back shares with a single digit or PE that likely is going to start growing their EPS pretty fast. And then on top of it, right now, with all the recessionary impacts that we're seeing that the interest rates are likely to fall mid 2024 and then go to 2025. They're going to fall even further, which means even their debt servicing costs on that refinance debt that they have coming up in 2024 and 2025 is going to be at pretty decent rates. So it's not going to impact their bottom line very much. What I really like about them, though, is that they are a defensive play in the middle of a recession. Unlike other companies that are negatively impacted tremendously by higher interest rates, Verizon is a utility. No one cancels their utility. This is like one of those core things that all businesses and individuals need. And so Verizon, if you look at earlier last year, before all the rate increases, Verizon was actually trading at a pretty good pace. So even in 2022, the first quarter, they were up 5%, with the S&P was down 7 and 10%. So right now, based on just valuations, and if we do get hit by a recession, I think there's going to be a good amount of people that see the same thing and start to actually buy into Verizon. And that's one last thesis. And then one last thing, of course, when you look at Verizon's yield right now on their just their stock, their dividend, it's 8.5, almost 9% yield. That means that, number one, as they grow their dividend, it's going to get better. And then at the same time, if interest rates go down, you're going to have yield chasing. A lot of people don't realize that what happens is right now you can get a risk-free return of about 5.25% from the treasury for a 2-year treasury. That's fine. The problem is when that treasury ends up, and when they start cutting rates, then goes down to 3 or 4 or even 2, people aren't going to say, yeah, I'm willing to just accept a 2% return. Fund managers can't accept a 2% return. Right now, they can do 5.5%. That's fine. But eventually, they're going to need to make money. So what are they going to do? They're going to do what they always did. They're going to yield chase. And they're going to buy up companies like Verizon. And basically now you're going to have, in my opinion, Verizon jump up to like at least $10, $15 from where it is today. So you're looking at maybe like $45 to $50 a share in stock price, on top of an amazing dividend that you're going to be collecting that's going to be growing, with a company that's possibly going to be buying back shares in 2025. So like I said, this one's a no-brainer in my opinion.
My question is would it be prudent for them to, now I'm not exactly sure if they were to go to the market, what somebody would pay them in terms of an interest rate on some of these bonds. My question would be to you guys is, what do you think it'd be smarter for them to hold cash now rather than paying down some of this debt, so that they could actually grow their cash pile and really just try to hold off until they can refinance some of this debt at an even lower rate? Now, you'd think it'd be more prudent for them to pay off the debt now rather than... They
need to get that debt level under 100 billion. That's a critical level for them, because then their debt to EBITDA ratio declines significantly and it gets a much different view in the investor eyes.
But that's a net debt, right? So you have to think net debt is technically whatever the debt load is minus cash divided by what the EBITDA is. So technically, either way, if they were to knock out the debt, I know exactly what you're saying, right? But yeah. I'd look at it because my company uses gearing ratio, and I think a lot of European companies use gearing ratio rather than like debt to EBITDA and stuff of the like. But
Matt, you got to remember that a lot of investors and a lot of people that discuss these stocks are looking at their debt load, and that's one of the big red flags about Verizon. Everybody knows that they're generating tens of billions in free cash flow. Everybody knows that they're a dividend machine, but they're seeing the lack of earnings growth and the high pile of debt. They need to take the debt off the table so that becomes a non-factor. Then there's nothing left to complain about. And to echo what Chris said, and I've been writing about this quite frequently because I think a lot of people are missing this point. Right now, you have rates at the highest they've been since the early 80s. You're getting 5.5% on a 12 month. You're getting almost 5%. I think it's like 5.9% on a 10-year. Now, I have cash in CD. Sure, other people have non-risk assets. But when the Fed starts cutting, and as I showed on Finance Junkies, it looks like the middle of 2024 is when the shift in the projections comes. When the risk-free rate of return starts declining, and that sweet spot of, okay, now it's only a 4.5%. Maybe I'll roll it one more time if I'm in a 6-month or a 9-month CD. But once it starts getting to 4% or 3.5% yield,
people are going to start moving into
risk-free rate of return no longer becomes that attractive. No. Especially when you say, okay, well, I can get 8.5% average in the S&P over a period of time on appreciation. But if I'm looking for income, that risk-free rate's no longer servicing my needs. And when money rolls out, there's over $5 trillion in money markets. It's going to flow in to income-producing assets, because anybody that's putting money into a CD or a T-bill, they're not necessarily just waiting it out. They're generating income. They're most likely looking for income. And that's going to go into, my opinion, Altria, which is one of the most interesting stocks, Verizon, AT&T, and some REITs that have gotten hit pretty hard. Chris and I are going to disagree about one of them, and we'll agree about one of them. But you're going to have, over the next probably 12 to 18 months, when rates start coming down and continue to get cut, especially don't forget, we're going into an election year. There's going to be so much pressure on the Fed to cut rates going into that election. We may see a jump with the cuts. And the money's going to go somewhere, and it's probably going to go into income producing assets.
No, I mean, you saw this extensively where a lot, and I think this is why a lot of these companies have been getting hit so much. Verizon, Pepsi, a few of these others, now that things are risk free.
Pepsi is ridiculously.
Yeah, it was trading at price earnings at 30, right? And
crazy.
Now people are like, well, it's a buy, and I'm like, it's still trading above 22 times earnings. It's not a buy right now, right? Especially in this environment.
Coca-Cola is way more of a buy than Pepsi.
Yeah, so I mean, you have to think like, I think a lot of like what you're saying is right now you can get risk-free returns from a CD, from a savings account, from a money market fund. And as that disappears, just like how people were piling in the whole 20 teens into Altria Group, which has been challenged as of late, but people were piling into that where the share price went up to 70, 80 bucks in Altria Group because people were just looking for yield. And where else can you buy it than cigarettes? People, it's going to decline. And if you're able to know what your income is or how much you're declining every year in terms of smokers and slowly raise the price, you're going to be able to maintain that margin. And boom, Bob's your uncle. You have an idea as to what the dividend income is going to be. But
Altria is buying back a ton of shares, 54 years of dividend increases. They have the market cornered on dip, cigarettes. They own 10% of Budweiser. They own Canopy, I believe, which with the new banking laws, we may get some reprieve. I think marijuana is going to be a very big industry in the next 5 to 10 years. Altria is set up. It's very interesting.
Interesting. So let me ask a question. Is this more of a short-term next 2-year reversal play as interest rates get to more favorable rates where Verizon is kind of riding their ship, they're getting rid of their long-term debt, they're getting themselves back into a financial fitness shape, and the price is going to jump, and then something that things kind of normalize, the dividend gets back down to a 5.5% yield, you sell out, and then you look for the next nugget? Or is this something that you're going to continue to just reinvest those dividends and hope for the next 30, 40 years this is going to be a play?
Unless something changes, I'm holding for 20, 30, 40 years. For the simple fact that I'm buying now, my yield on cost is 8.5% right now.
For sure.
And I'm going to reinvest those dividends every quarter. They're going to spawn, create more shares, keep generating more money. And I'm buying it for income. If I want capital appreciation, I go buy something else.
For sure. I guess my question is the thing that confuses me a little bit with some of these companies, specifically dividend-focused stocks. And I'm not saying you're wrong, and I think Verizon's going to be around a lot longer than I think it will be. But something like a Starlink comes out of nowhere where satellite internet is a thing that might wipe out. But at the same time, 5G at the moment is the creme de la creme. So right now, 5G is the one that's kind of holding the key to the kingdom with respect to everything at the moment. But at what point is there some sort of crossover where satellite internet is a real thing and that ends up being cheaper or more cost effective or faster? Or I don't know the answer, but my fear is Verizon just a couple generations away from being something that their main cash cow is eventually going to get disrupted? And that's where I'm like, are they continuing to innovate? Are they continuing to go down a path of reinventing themselves? And do they have the financial flexibility to do so? And I guess that's a fear for 10 years down the road. But I mean, that's just my thought process about it. And then Chris, I'm kind of curious, or even Steven, how would you play this opportunity if you were, say, looking at it from scratch? Chris, I know you bought shares. Steven, I'm not 100% sure if you bought shares. It sounds like you have. But would you play the options piece of this at all, write poor man covered calls, or would you just buy the shares themselves and write covered calls on those? Or just own the shares outright and not risk covered calls?
I would do the inverse. I'm buying shares and I'll write covered calls on my position to manufacture a higher dividend.
I'm doing spreads, vertical spreads on Verizon, long dated. Right now, the options are trading super cheap for some reason, so I'm gonna take advantage of that.
I'm assuming you're buying 35s.
I'm not gonna say on Patreon. I mean, I'm not gonna say here. That's only for the Patreon people. They
There you
know.
go. There you go.
So,
And
Matt, to answer your question about Starlink or other companies like Starlink, I think that
And
the
I'm not trying to shit on Verizon, by the way.
no,
I'm
no,
actually
no, no.
genuinely
It's a fair
curious.
question because I've thought about it, and my current line of thinking is the FTC is not going to let that happen. I just don't see it with all the monopoly talk and antitrust stuff. I think that if a Starlink, especially Starlink being tied to Elon, I think that if you tried going after the everyday consumer and not people that have boats or planes or need it for industry or something, I think that the FTC would step in and say absolutely not, especially with all the lobbyists and everything. I just
The thing is, satellite internet it has a lot of limitations. People forget that. So number one is inclement weather. You get hit with inclement weather, regardless whether or not you have a strong signal, you're gonna lose connectivity. So that annoys people. The other thing from a cost perspective is actually super cheap to get 5G home internet. Right now, literally the setup process is you get a box and you plug in the box and that's it. Nothing else. Like it's very simple. I mean, the only part is you log into the app, of course, and you set your password and username and password so no one else can use your home internet. But it comes with a Wi-Fi like system in the little box itself, right? So the cost to adoption is literally nothing. It's like I order it 20 and it's like $35 right now per month for like high speed, and then if you want to go up a little bit on your bandwidth, it's a little bit more. But dude, they can upsell this so much with existing clients first and just say, oh, you have a T-Mobile plan, here you go, you can use this, and basically get those people on there. And it just opens up an entire new avenue of customer, especially customers that are looking to get the hell away from cable, which has become kind of predatory, like the way, because a lot of places they know that cable is the only form of internet that's available. So they've really jacked up the rates in those areas by a lot. Like I had Optimum before and it was costing me like $85, $90. Right now, my 5G home internet is costing me $40. So literally half the price, and the quality is better. Like I haven't had any downtime.
What's your Mbps down and up?
You mean officially? Let me see.
Yeah, if you were just to go to speedtest.net and run it,
like
obviously not now
200.
because you're using bandwidth,
Yeah.
but what's your up and down?
It's usually like
two. No, it's pretty good.
It's usually like, yeah, it was like 200. Like usually if it's not, it's like 200 megabits per second. Yeah.
Oh, so yeah, that's well worth it.
Yeah, and if you look at the new 5G ultra wideband, take a look at this. That's coming out, because like they can actually, hold on one second, share my screen. Okay, can you guys see this? Right, this is in New York with their ultra wideband.
This is Jamal from Elite Tech TV. I'm in New York City, going to do a quick speed test using Verizon's ultra wideband 5G speeds. Let's get it. Whoa.
Get the fuck out of here.
That's impressive. Close to 2 gigabytes. Over 2 gigs. Wow. This is amazing.
2.6 gigabits.
80 megabytes. Well, 70 megabytes.
Tell me how anyone competes against that. And it's not just them. Like you're seeing them all around the cities and the country right now with that kind of bandwidth coming out. So, and like I said, their coverage map is growing like crazy. So, like, I mean, at T-Mobile too. Look at this. Oh man, we're gonna get deep.
I mean, Chris, you're an IT, so yeah. You're gonna back up what I'm saying and say it's bullshit or not. Most companies, unless you're a really big company with a big footprint, you're not even getting a gig circuit. You may be getting a 500 meg circuit. And it's very rare that companies get more than a gig circuit put in. I mean, that's crazy, 2 gig down.
Yeah, well, the thing is, like, and someone said, it only works where there is tower density, aka cities. That's the whole point, right? Where once demand fills up, they're going to build more towers. They're going to put more 5G antennas up there. And we're not even talking about 6 gig, because 6G is like the next generation of stuff that's coming out. On top of it, you know, yes, speeds can vary, but from what I can gather, like, and I'm in a pretty residential area, it rarely fluctuates that much. I never have an issue connecting to what I needed to connect to. I always have like an HD signal. So I just think it's such an easy thing to easy to say. On top of it, I think there's a lot of other items that are going to be coming on the network that people don't necessarily like equate to, like, you know, like connected cars right now. You know, eventually everyone's gonna have like, hey, you know what? Maybe I will get a plan for my car to have internet signal so that it can have the advanced features on the car itself without having to connect to a cell phone or whatever, right? So as an example, something like Tesla or these, they're going to need some level of connectivity to the cars, right? Because to do over the air updates and everything else. And I'm sure that is eventually going to feed into some profits for these guys as well. But I think right now we're seeing this transition to 5G, and these guys are one of the biggest leaders in 5G, and they have a huge amount of spectrum that they bought. I think that's the key for me when it comes to the valuation. The spectrum that they bought, huh?
They came out with the most. AT&T came out second. T-Mobile/Sprint got like buck bits in the whole FTC sale for it.
Yep.
Yeah, I'm actually in the process of moving within the next month, and I'm like feverishly looking. And my house is new construction, so I'm like, is the only reason why it's saying that it's not showing up at the moment because it's new construction, or is it actually just not available? And it's frustrating me because I feel like Houston should be a pretty well-covered city when it comes to 5G.
Well, no. It comes down to, once again, it comes down to coverage that they weren't allowed to. Let me just show you what I mean by that. Hold on. So right now, if you look in the news, this just happened like a couple of weeks ago. Not even a couple of weeks, but right here, Verizon, they just got hold on. They just got the God damn it. There we go. Right here. Verizon turbocharges its 5G network with additional spectrum, right? So a lot of that spectrum was being held back by the satellite companies to do the clearance because they were the ones that had access to it. So right now, they actually just got off of that. So where is it? It uses C-band license between 140 to 200 megahertz in all available areas. So damn it, man, I don't want to read this entire thing, but okay, since Verizon began deploying 5G services using C-band spectrum, the lightning fast 5G has become available in more than 222 million people in 359 markets, and more than 40 million households have access to Verizon's home internet with 38 blah blah blah, all this bullshit, all this stuff here. But basically, a lot of that clearance work was the reason why in certain areas you didn't have the availability of 5G home internet. I guarantee that's going to reverse over the next 3-4 years, in which case it'll become available. Do you have it? Is it available in your area right now, Matt?
So I'm looking at the map here, and it shows that at least the ultra wideband is available. So I think it just might be the fact that it's just not set up in my home community, because mobile 5G is set up pretty much throughout the entirety of Houston. So I'm confused why the home internet would not be. I'm assuming it's a part of at least a similar network. So it might just be the fact that it's a new home.
Yeah. It might just be build out as well, like making sure that the area gets enough densification to make it worth it, you know? Yeah.
Should we just
checking Houston? You got to put in your address, right, in order to see that.
Yeah. No, I checked it.
Okay.
It's for some reason just the same thing with T-Mobile.
Check T-Mobile. Same thing.
Yeah, it's same thing. I think it might just be because it's a new home. you know.
Yeah.
So maybe I'll check the houses next door and then call them up and say, just send me the damn box. It'll work. But curious now. I'm not sure if you guys have any other thoughts about Verizon or any last final points, but I'd like to move on to a company that I think all three of us are shareholders or at least hold bullish options in, which is SL Green. Any other last thoughts about
listened to
Verizon?
the conference call today.
I did not. I didn't get to it.
I did. I listened to it. So, the first thing is one of their longest members that they've had, Andrew, I forgot his last name, but
President,
he's leaving the company. He's worked hand in hand with Mark Holliday, who's the CEO for the last 20 something years. The thing is, and the reasoning that they gave, like, this wasn't like a departure where they said, you know what, we're going to get rid of you. This was an amicable leave. And the reason why, and they gave it, which made total sense, was that we're entering a new phase of investing in New York City's real estate market. And so a lot of people, a lot of these young guys, they're coming online and they need positions where, they can make some impact going forward. And Andrew's been around for 20
years.
He's staying with the company. He's not going anywhere. He's going to be on the board. So that was one of the good things about this whole transition.
Succession planning is a huge thing in companies.
Yeah. So succession planning is one of the things that's happening right now at SL Green. And if you look at it, and this is what I love about Mark Holliday, he's just like, look, we had stretch goals of getting to 92% occupancy. We may still get there by fourth quarter, but they're getting pretty damn close. They're close to almost 90% occupancy post-COVID from where they were. And they've been signing a lot of leases, and at the same time, they've been gaining a lot of traction in leasing activity. So I think eventually they will recover. But in the short term, dude, these 10-year treasuries, man, it's just, if you think about it, these guys do the same thing. They're competing against the 10-year treasuries yield. So yeah, people are going to ask for way more in terms of yield in order to buy the stock, because you're essentially have a risk-free return with the 10-year treasury. This company, you're going to get like a 9% return, but you're going to take on some risks in order to get it. Also, treasuries have tax benefits that REITs actually don't have tax benefits on. So that's another component that you have to kind of play into it. So right now, a lot of what's going on in a lot of companies, it's primarily being driven by the 10-year yield spike. And that's not a good thing. The other thing is the cost of capital to borrow also goes up as the yields go up. So SL Green has a lot of debt right now that's all hedged. But in the future, when some of that debt does come due in like 3 years, if they have to finance at a much higher rate, if rates are what they are today, then yeah, that could impact their profitability. But as far as I'm concerned, they're based on what I heard during a conference call, the dividend is not up for grabs. They're not going to be cutting that anytime soon. They're not going to pause it. Like Vornado paused their dividend. SL Green said, no, we're going to maintain the dividend. That's one of the reasons why people invest in SL Green. So I like the fact that they're aligned with shareholders on that aspect. And yeah, and overall they're just a really well-managed REIT, and they're doing exceptionally well in terms of their business. So yeah. And they also have a lot of short interest that could
a lot of short interest could help it pop. But I think the thing that has been, the most beneficial for me, they're still undergoing a lot of work that they're building out. So One Madison, I think, has now gotten temporary occupancy, which I think is a big milestone, where they got $500 some million, which is going towards debt. And I think they have a few other places that are under renovation as well. And the thing that's beautiful about a lot of these is One Madison, even though it is just kind of coming into temporary occupancy, is almost fully leased out already. And you're talking about big clientele like Franklin Temple, IBM. Yeah, a lot of huge companies that are really looking forward to moving in. And I don't think any of that revenue has kind of hit the streams yet. So I think that when these people finally do move in, they start paying, that'll be really cool to see. And then I think you have a few other buildings that are in a similar place that are almost towards temporary occupancy. And once that happens as well, they're going to get more payments. and more milestone payments from their partners. And so, one, if you're just looking at it from this perspective, their funds from operations is still in the 5 to 5.25 range. I think their goal now is $5 to $5.30. So that just means 80 to 90% of that is going to be given out to shareholders. So that's a good thing overall, just to kind of look at it. But if you look at that, that means you're paying a price to funds from operation below 10x, which anything below 10x, especially if it's able to continue and sustain, is impressive in my opinion. And Chris, I think when you and I looked at it the other day, I don't think that the upcoming debt is too crazy on SLG. Maybe I'm thinking of a different company, but this might be something where Steven has a little bit more insight, because I know he was kind of preparing in the background some of this work.
I got you.
And to me, I think that they are more than able to sustain where they're at and build kind of going forward, to the point where I have a couple hundred shares. I wish it was in the thousands. It's not. But maybe if I have an opportunity and sell something that I kind of want to move out of, it could be an opportunity, even the low 30s, to add position here. But I think this is easily able to go back to the $50 to $60 range if they're able to sustain from here on out.
So I'm going to give a little bit more color on my thoughts about this, because this is actually one of my highest conviction picks for the next 2 years, going against the grain. I think a lot of people are wrong. And I think that it got hurt on earnings because people didn't read the fine print that SL Green is taking a 10-cent per share expense on severance and 17-cent per share on the accelerated stock-based compensation expense because of Andrew's departure. These are one-time expenses that would have occurred anyway if he retired next year or the year after. So putting that aside, I think that a lot of people hear about the $1.5 to $3 trillion coming due over the next 3 years in commercial real estate. They see that Brookfield, and I forget the other company's name, return the keys to a 1 million square foot mall in San Francisco to the bank. And there's a ton of worry about commercial real estate, especially office, with work from home or hybrid still being a thing. I'm in New York City 3 to 4 times a week.
Yes.
I'm in Midtown.
And it's buzzing.
Bumping. It is absolutely bumping. Okay. You look at the comptroller report from New York. The last time I looked at it, 67% of the pre-pandemic levels on the subway riding, and the average amount of time people were in the office was 3 days a week. You're back. That's within a 3% ratio. Now, I have a theory that, and Chris can attest to this because he works in the city. You come into Penn or you come into Grand Central. Okay, you're in Midtown, you're east or west side. The pandemic has changed people's mindsets, and I think that there is less of a desire to come into the city from Westchester, Long Island, Staten Island, or Jersey on the path, whatever you're taking, LIRR, and then get on another freaking subway to go downtown and then walk 20 minutes to the office and then do it again to get back to your train home, or go uptown. I think you're going to have a convergence on Midtown, east and west, to be closer to the main entry points into the city. And I think that you're going to see also Class C and possibly Class B real estate be under tremendous pressure, because I think you're going to see companies want that Class A space with the more amenities and be closer to the main points of entry in the city. And SL Green has arguably the best properties in the city. They really do. And you have a nice kicker that may or may not happen, but there are 3 casino licenses up in New York for downstate. Most likely Las Vegas Sands is getting one of them for the Nassau Coliseum. They signed a 99-year lease, I believe. They're probably getting one. That leaves 2 more. Caesars and SL Green are partnering, and they're trying to put one in Times Square. I got to believe that if one of the licenses is going to New York City, it's going to Caesars and SL Green, considering that the other one's probably going to go to the Aqueduct. So we'll see. But on the metrics level, I'm going to share.
And while you're pulling that out, Steven, I don't live in New York, right? I know you guys have that firsthand knowledge, but there's very few places you can fly into when you're moving back into the country from Trinidad and Tobago. And in September 29th of 2020, I had to repatriate back to the United States. And I was terrified for my fucking life getting into the train station of how many fucking people were around me. I'm coming from a country at that point that was allowing 0 people to walk around or do anything. And I'm shoulder to shoulder with everybody in this goddamn subway station at Penn Station. And I'm just like, oh my God, I'm going to die. Like the news is trying to kill me. But regardless, it's like, I was a surprise back in 2020 how many damn people there still were riding the train system and everything.
Unless you've been to the New York City in person, I don't think people really understand how big it is. And then, Chris, before I get into these numbers, have you driven over the 59th Street Bridge in the past year?
I haven't. No.
The next time that you have an opportunity to, do not take the tunnel. Go over the 59th Street Bridge. I remember 12 years ago, it was only the Citibank building and that other glass building next to it. There was nothing there. The amount of buildings in Long Island City is crazy. It's really nuts. The construction is nuts.
Yeah.
So I looked at the largest market cap office REITs in the country. SL Green has a market cap of $2 billion. Okay. There, I used the middle point for funds from operations of their guidance, which is $5.15. Their current book value is $60.53. You're currently paying 6.17x their funds from operations. And you are buying the creme de la creme office buildings in New York City. One Vladdy, Madison, I mean, you name it. You're getting a 47.5% discount to its book value.
Yeah.
It is nuts. It is absolutely nuts. I mean, Boston Properties is one that I always wanted to buy, but I'm not because of their exposure to California. But you look at their numbers, I mean, you're paying 7.5 times FFO, which is very good, but they're 42% premium on shares based on book value. I mean, unless you really think SL Green is going under, you're getting a huge price per book. Yes, the net debt to EBITDA is a bit high compared to some of its peers. Not nearly as high as Vornado's. And SL Green has done a tremendous job of lowering its debt. I think they've paid $2.5 billion in the past year and a half. In this quarter, they, signed 50 Manhattan office leases covering 355,000 square feet and 134 Manhattan office leases covering 1.27 million square feet in the first 9 months of 2023. And what Chris was alluding to before, that pipeline is over 1 million square feet, which could come through this month, next month, into early 2024. And on the call, they did say that they think that they're going to be at that 92%, if not this year, sometime next year. This is not a distressed asset. And when I look at these numbers, you're getting a 10.5% dividend yield that's paid monthly. Company that is adamant about keeping the dividend intact. You're paying a very good price to FFO ratio. You're getting a huge discount on book. And their FFO coverage ratio is almost 1.6x. I mean, this just makes all the sense in the world. And then you think about the valuation metric. And I'm not going to waste time and pull it up. I'm just going to do it from memory. So give me a little bit of rope. But the big thing was real estate assets are going to need to be marked down because they're going to be distressed assets, blah, 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 blah. Chris, what was the address? 240 Madison or 248 Madison? Do you remember?
245.
245 Madison. So they had like 160 million in preferred equity. They ended up buying the entire building in 2022. All in price was, I think, 1.99 billion. In June, I believe, of 2023, they sold 49.9% to one of their
625. It's 625 Madison.
Okay, 625 Madison. So they sold 49.9% stake in it for $1 billion. That means that at the height of inflation, the height of regional banking going crazy, and everybody worried about all this, they got the same valuation that they paid for it a year before when rates were not going up the way that they had. Okay. That means that their assets are not getting marked down, my opinion, and their book value is real. So if the book value is real, that means you're buying an entire asset of buildings at almost a 50% discount. So I'm willing to keep buying shares and hold this for years and years. And the 28% short interest, some point when the Fed pivots, I think that they're going to be fried and we're going to clean up.
This so one of the just caveats I want to point out about 625 Madison. So basically 625 Madison, there was definitely some power struggles between the old operating lease owner, the ground lease owner, and how much they paid for it and everything else. But SL Green came out on top of that because of just how good they are with negotiating some of the deals. What ends up really being interesting about 625 Madison is that it's on Billionaires Row. Literally, it's right on Central Park South. Like that area right now, they could sell the damn thing for like huge amounts of money and just have it get it turned, because it's an entire square block, by the way, in New York City, right in the middle of goddamn Midtown. Like it's nuts, man. So the asset quality of the buildings that they have is just on another level, and the amount of money that they're going to be able to collect is just, it's crazy. So yeah, I mean, to anyone right now, this is what you're looking at, And
look, it could keep going down. Yeah. There's no reason why it doesn't keep going down with all the fear that's coming out in the market. But I can't time the markets. I've never tried to time the markets. I'm looking at this as a multi-year play, and I'm continuously buying. I think I bought shares at least 20, 25 times in the past year. I could look and figure it out.
Yeah, I'm just reinvesting my dividends at the moment.
My cost of entry is only $22. I got in literally at the very bottom. So, and I'm doing the same thing as you, Matt. The dividends, I just had them dripping right now, and it's in my tax deferred account.
Yeah, I have mine in my Roth as well.
Yeah, so my Roth right now is just literally every month it comes in, it just buys the SLG position for that, and it's good.
Yeah, I don't have nearly enough because I didn't have enough in my Roth. Yeah, I'm at my cost basis is, well, that's after a few drips. So let me see my current purchase history. I bought on May 1st, 23.47.
Nice. That's when I messaged you on Twitter, right? To take a look. Yeah.
I think a week after that, I started buying. So yep.
I've made 27 individual purchases in my main account. My cost basis on those is 27.43. I bought it up, I bought it down, in the middle, blah, blah, blah. After the dividends I've collected, my price per share is $25.99.
Nice.
Yeah, you
and I'm still buying. Look, if it goes under 30, I'm buying more.
I'm buying. I sell puts every month. Did I just sell some today? Let me see. I might have rolled them out. I might have been. No, I didn't. But for now, I have. Did I buy them back? Where the fuck are they? I guess I bought them back. Did they end up executing? But yeah, normally what I'll do is I'll sell 45 days out, and just hope that they continue to just roll and roll and roll over time. And I think I sold the $25 SLGs. And I think I had them at November. So I don't see them in here, so I guess I bought them back. But that's kind of the thought process is if they get down to 25 bones, I'd be more than happy to pick them up. And I think I was selling 5 contracts, and I think I was selling them for like $1.50 a piece or something like that. Where the hell do these things go? I don't see them in my orders.
Yeah, that doesn't suck. I have a number of shares that I want to have, and I plan on buying until I hit that number. Chris and I spoke about this a month or two ago. I think when it gets to around the $50 range, I'll start selling covered calls at probably the 55 or 60 chain. Because look, if it ends up in 3 years from now, and I have no idea when, I'm just picking an arbitrary number, if it gets back to 50 or 55 in the next 2-3 years, I'll start selling covered calls at 60 on half my position. Why not?
Yeah. 100%.
I don't know. It just, the numbers work. And I think that the shorts are making a very big mistake. I could be the one making the mistake, but I think the shorts are, because I think they're bulking SL Green in with all the other commercial real estate and all the fear in the market for that sector.
The one of the things I really like about them is that they don't have exposure to Chicago and they don't have exposure to
San Francisco.
Because some of the other ones, they have exposure to both the coasts because they have buildings over there. I know Vornado has exposure to Chicago with one of their buildings, and I think they even have a San Francisco.
Pull up Boston Properties and look at the amount of property they own in California. That's the main reason I have not invested in that.
Yeah.
Mm-hmm.
I mean, monthly dividend at this level with this discount to book, I mean, it's hard to pass up.
Mm-hmm. Yeah. And like I said, once the rates start coming down, they're going to get double benefits. They're going to get one lower, like the future of lower interest rate refinancing. And at the same time, people are going to be chasing yield. And when they start chasing yield, they're going to shoot the stock price higher.
And people love REITs.
Yeah.
When risk-free rate of return is not here, the majority of people are going to invest in REITs, not business development companies and not MLPs, because they're not going to want the K1 in a taxable account. And most people don't even know what BDCs are.
I have a question for you, Stephen. What REIT do you like that Chris doesn't like?
Realty Income.
Oh, okay.
For different reasons.
I sold recently.
Yeah. And I do agree that Chris made a very good point about it on Finance Junkies the other night. I caught him. I agree with a lot of what he said, but I look at O as a company that has consistently had such a high level of occupancy. The dividend has been increased like 160 quarters out of, I don't want to get bad numbers. It's right on their website. I don't have it up. It's the gold standard for now. And I don't see their portfolio getting that weak. I think for some reason AMC will make it, even though I don't know.
Okay.
I don't see O doing that bad. I really don't.
Yeah. I mean, we don't have to get into here, but I always, even when I bought back into O starting a couple years ago, I always knew eventually I would sell. And I think the reason why is just because I just don't view CVS's, Walgreens, places that I think 5-10 years ago we would have viewed as staples within our organization, or staples within our everyday lives. I don't think they are anymore today. And I've seen multiple around me just in Houston close up shop. And now those places are sitting vacant. Like I was like, oh, maybe they'll put some other crazy store there. Like I can't believe they're not renewing this CVS lease. And it's still just sitting there with a big fence and graffiti. And I'm just like, this isn't a very busy part of Houston. Why is there?
I would look into, Matt? Look into OHI.
Omega
Healthcare. They are a skilled nursing and long-term care REIT. This is a segment of the population that has an influx of new candidates every day and every year. Mm-hmm. And OHI is one of the best run REITs in that space, triple net. I've held it since end of 2017, I think. Up and down, up and down. Dividends 8.5%. I can only say good things about it. And then I love Starwood because Barry Sterling is, in my opinion, the best CEO.
STWD.
Yeah, he's the best CEO in the REIT space, in my opinion. Held
Yeah,
that for a long
that's a
time.
more. Can you explain for people that might be new to real estate investment trusts or just maybe
Hey
don't
guys,
have-
I gotta head out. I'll see you guys later.
Okay, you're the man, Chris. Thanks for
Right,
your input,
Later,
tonight, my
guys.
brother.
Have a good one. Bye.
You're the man. Quick question for you though. Do you see a huge difference between, say, a normal REIT, like an O Realty Income, versus a mortgage REIT like Starwood? And would you explain the difference between the two for people that might not necessarily be familiar with the difference?
So it's pretty late. I don't want to get into everything when my brain's not firing all cylinders. The
Yeah.
major difference is a REIT like O is considered an equity REIT, whereas Starwood is actually a hybrid because it does a little bit of everything. And then you have your mortgage-backed REITs like an AGNC Investment Corp type thing, or one of the more popular ones, probably Adelaide Capital Management, NLY. And I would speculate that REIT investors would look at mortgage-backed security REITs a little bit more risky than equity because they don't actually own the equity in the assets. They own the underlying mortgages that they're buying from the issuers. So that has a lot more to do with credit profile, debt profile, and those types of things. But there's some interesting REITs out there, and I happen to love Starwood, really do.
Mhm. Yeah, they always pay a pretty good dividend too, as well, right? What are they trading at these days, by the way?
18.5.
Yeah, that'd be a good entry price for anybody that's looking. And I think that's going to be something that shoots up to the mid-20s when you see a rate reversal. I feel.
Pull
I
up a
mean,
5-year chart. It's up and down, stays within a range, but the dividend's unchanged. $1.92 a year. Dividend fluctuates between like 8.5 to 11% yield.
and why does it stay in that range? By the way, I was always kind of curious why it never really fluctuates all too much.
I can't figure it out.
Okay. I was always just kind of curious because it seemed like they're in a good spot where, but anyway, I'm curious. One of the ones that I still hold on to, I've divested out of WP Carey, and that's what I used to buy SLG. And so I sold in the high 80s for that one, which ended up being a pretty good time to
That was
sell.
a great move.
And then I bought SLG and I'm up 40% on that. So pretty good move because I think I'd bought into WP Carey 2016, 17. So I was up like probably 30, 40, if not 50% on that. Because that went from 50 odd, 60 odd when I bought in to 80 to 90 when I sold. And then I took that money and bought SLG. I really liked WP Carey. They were doing really well, but I saw the book value potential of SLG and the turnaround story. And so luckily I well timed that off of the suggestion of you and Chris and looking deeper into that. Curious though, one I've held since 2015 timeframe. Stag Industrial.
Love Stag.
Yeah, but I'm curious, do you see that as a good continuation of the e-commerce trends that have been going on, I guess, since 2015, 2016, which have helped, I think, immensely kind of keeping that industrial warehouse REIT up and going?
Yes. So look, Stag doesn't have the biggest yield, but it is a super solid REIT in my opinion. And I think to answer your question, I need to find something from one of my previous articles. Because I think people need to understand the e-commerce segment. I probably put it in a Simon Property Group, which, by the way, is one of my favorite REITs.
How are they doing? I'm sure they're getting smacked right now.
7% dividend. I mean, look, there's some Simon Property Group malls that are kind of near me. I mean, this is. I'm a believer that the malls are not going to, Class A malls are not going to be replaced.
Yeah.
It's not just shopping. It's a place that you have experiences. You have restaurants, movies, putt-putt, whatever. There's a ton of things. So I found what I want to share. So when you start talking about Stag, you can't talk about Stag without talking about retail sales and by channel. So right now, it is projected $6.86 trillion in U.S. retail sales this year. 1.23 trillion is e-commerce. Next year, 1.41 trillion is e-commerce, and then in 2025, 1.6 trillion. So e-commerce sales are going to be 13.8% of total retail sales in 2025, but they're growing in volume year over year. So you're going to continuously need industrial space. And it's just going to keep growing and growing, in my opinion. I can't wait for the next projections to come out. So, no, it's one of those things where this trend is going up. It's an easy equation. This trend goes up, you need more space, whether you want to house it yourself or pay for warehouse space. But you're going to need warehouse space. Stag is the one that I think is probably the best in the space in that. So I like Stag. It's not my top pick, but when I invest in REITs, I'm not necessarily going for cap appreciation. I'm looking for dividend quality and generating income. And there's a few that I like. I own Stag, and I think Stag's a great company, and I think it's going to do well.
Okay, very good. All right, well, I appreciate you being a guest. I know we asked you literally an hour and I guess 20 minutes before the stream, and we were finishing up Finance Junkies. But love to have you on in the future, especially when it comes to other topics. But I knew it was good to kind of have you on for SLG, and then also it was really cool to hear about Verizon and your thoughts there. Verizon, I'm trying to remember if you said it. You're buying strictly shares. Are you buying any long calls either, or just shares?
I don't play the option market like that. I write covered calls. I don't buy options.
Yeah. Some people I know in the past, one thing that I used to do was poor man covered calls, and what we generally would do is we would buy companies that are pretty low volatility, like a Verizon, and what you would do is you just buy the 2026 long call, and then find a spot where it would make sense to sell a covered call and just capture a little bit of income that way. And eventually you get to the point where your call options, which generally speaking were kind of deep in the money, you wouldn't be buying them far out of the money. So in this case, you might be buying a $25 2026 long call, and then you just write covered calls, and you might be able to say, if you had 10 grand, buy way more contracts than you would be able to buy shares. So, you'd be able to control a lot more and be able to manufacture a lot larger of an upside opportunity than if you were to say buy the same amount in shares. So anyway,
I think at some point you and I should do a oil and gas podcast.
Sure.
There's a couple of companies obviously that I really like. I am more a midstream person. So I think
more pipelines.
I think Enbridge is super undervalued now. I really think Energy Transfer is still probably my top pick for the past 2 years. Love them. And there is opportunity there. I think there's a lot of opportunity because when you look at the trends for oil and gas going out the next several decades, it is not going away. It's going to grow. It's going to need to get transported. And I don't think people realize the U.S. is producing the most oil that it's produced ever right now. It needs to get transported. These companies.
Yeah, I made a LinkedIn article about it. 13.2 million barrels as of last week.
Oh, shit. They broke 13. I didn't even see that. They were like 12.95 when I looked at it the other week.
Yeah. So what was I going to say? Yeah, and then I think a lot of people don't recognize, but the United States is going to be a mass exporter of liquefied natural gas.
I've been beating that drum for so long.
Yeah. And so there's a few. Chris and I did one on Tel, which is the Rio Grande LNG play that's right near Boca Chica, which is where SpaceX
I started
launched.
buying, so I own shares. They got called away at a much higher price than they are now. And I just started buying shares again not too long ago when it got to like $1.10 a share. And it is my lotto ticket is the way I'm looking at it.
Tel is, or?
Yeah, I mean, look, shares are the price of a lotto ticket. I'm going to buy shares every month until I get to a certain number. It could go down. It could go to zero. I don't freaking care because if it works where they end up building this damn facility, the amount of money that they're going to sell the barrels on water for, the spread is crazy because they own the land in Haynesville. They own the pipeline. They're going to own the exporting facility. Bechtel's doing all the stuff for them. They just bought the forget what they're called, but from one of the other big companies. I think maybe it was GE that they bought some of the stuff from. I mean, the amount of money that they are going to make in free cash flow to build the next 3 trends this company could be one of the most massive returns in the next decade if a lot has to fall into place.
Yeah. I don't understand why it wouldn't. I guess the company goes bankrupt. It can't sustain for a long enough time. I mean, that's really the only thing that I see.
My thing is 2027 is right around the corner. 2024 is 2 months.
Yeah. Yeah.
You
mean 2027 being when
that's when everything's operational and they start selling their LNG.
I don't know about that. I mean, I'd have to look at it again. I know they hit a milestone a couple months ago, maybe a month ago. But I've actually thought about buying real estate down there just because. I mean, if that ends up being built, one, you have Starship nearby or Boca Chica right
That's
nearby.
Not a bad idea.
So SpaceX is right there. And then, you got South Padre Island, which is right there. Great vacation spot. And so you got the border right there. So you have an opportunity in a multitude of different fronts. And if that Rio LNG gets built, there's really only 2 places you can live right next to there, which is McAllen, or maybe it's Brownsville. I'm trying to remember, or South Padre Island. So it's or the town that's directly west of South Padre Island, which I forget what exactly it's called, but it's not a lot of pickings for people that are going to work there. And so
here's the other thing. I don't think Sharif's going to fail. It is his mission to build this after getting screwed over at Cheniere from Carl Icahn. So I don't think that this is going to fail. I think this is going to work. I'm going to buy shares. I'm going to buy shares. I'm going to buy shares. And look, there's no reason this can't go to 100.
I have to do more due diligence. I have to look at it. I have to look at because what is it? It's going to be 19 MPTA.
No, I don't think it's that high.
Why am I thinking?
It's in the shareholder presentation. Pull it up. I got like 5-10 minutes.
Let me see. Where are you here? Telerin. Investors. Latest presentation, August 2023. There we go. And then we'll get you out of here. So let me see. Do you know where in the presentation?
I don't.
Or no, I'm not thinking. I'm not sorry. I was thinking of next
next decade.
Yeah, sorry, but either way.
Yeah, I mean,
I did look at these guys too.
When I did my research on it, I'm looking at some of the stuff I have written down.
There you go.
Tel's proved reserves are 99,508 MMCF approved reserves. They are set up vertically integrated where this can make so much money, where phase one development's 12 billion. Their gas sourcing is $2 because that's their cost because they own everything. Liquefaction and transport's $1 because they're doing it. The margin is roughly $9 per MMBTU based on where they think they can sell it at $12.
Yep.
I mean, this pays for itself, payback period in 2.4 years, and then the rest goes to expansion. So I think I found what you were looking for. Each Driftwood LNG plant is expected to have up to 4 liquefaction trains for a total design capacity of as much as 27.6 MMT per year. So first leg is 11 MTPA. I mean, it's supposed to be in place at the end of 2026. So
okay, that's where you and I were off. I was thinking about Rio Grande. I wasn't thinking about Driftwood, but I'll have to do some due diligence about this because 11 MTPA is not small.
No,
that's a pretty big amount.
They're the second. I don't like saying bad things. Hold on. I fucking put it somewhere. I want to say that they're the second largest permitted export for LNG in the country after everything is fully on. They're number 2 or 3. I want to say they're the second largest. Where the fuck did I put it? It'll take me fucking too long to find it right now. But the amount of permitted space that they have is crazy. Cheniere, I think, is the only one that's bigger than them. And don't forget.
I mean, here you see the annual operating cash flow to LNG, Driftwood LNG would be 4.4 billion before lease and interest expenses and stuff of the like. So then, that's at $14 an MCF. You know, is that real? I mean, that's a lot. But that's the thing is sometimes people they might not like the spot price. They might say, oh, well, we'll buy it from you at 14, but you know, we want to be guaranteed for the next 20 years.
Which is fine because their cost is much cheaper and they're selling it to Japan. They're selling it overseas. They're not selling it here.
Yeah.
Exactly. So the metrics work.
Yeah. Which Japan right now, I think, is at $12 or $13. So, and it's cheap right now, right? I think it won't be cheap come, I think, 3 years from now, where you start having a lot more competition and anyway. So, because the feed gas supply is gonna come up very quickly. The feed gas demand is going to come up very quickly, especially when these future plants kind of come online.
Yeah, I mean, I think that this is the exporting industry, and that's why Energy Transfer is so interesting because they have tremendous export capability, not just for natural gas but crude also.
So, silly question then: if you like Teleron, do you like next decade then,
or is that done enough research on them? I found
one's a lot more certain. One's a lot more certain, obviously. So next, I think would be 2029 export. So it'd be some time. That's not guaranteed, right? Like I think is guaranteed, versus next, I think is a lot further away of time.
I mean, I don't know if they're guaranteed, but it's close. You know what I mean?
Yeah.
It's close. It's hold on. Downloading. Here we go. All right. Where is it in this fucking file? I've written so many fucking things. It's amazing I can figure out where the hell shit is.
That's why they pay the big bucks, though, man.
Yeah, right. All right. So this is where all your shale plays are, which you're familiar with.
Oil.
This is
Who's thinking about oil? You cooking?
Well,
No, I'm just kidding.
Hold on.
It's a Dave Chappelle joke. Just give me a little rip.
So your LNG export terminals that are up and then approved, not built. Everything's in that Gulf Coast, right? Then proposed Gulf Coast. That's where TEL is. So I actually went and looked at every single one of them and looked at the BCF per day on each of them. And what I came up with is Texas has the second most outside of Louisiana. And when you go by company, TEL has the second most for an investable company for exporting on LNG, with Cheniere being the mega one out of all of them. Next is
Cheniere. As much as I like Cheniere, it's kind of already up and running, right? I mean,
and think about where Cheniere is market cap wise. You look at where TEL is. If TEL can actually do what they're saying they're going to do, and if they can perform, that lotto ticket. I mean, what's the market cap on TEL right now?
Yeah.
That's why I'm looking at TEL so closely, and I'm like, this is one of those things where I think it's going to 0 or 100. Market cap's 432 million. It's at 70 cents now. I'm going to buy more.
So it's literally 1% of the market cap of Cheniere Energy, LNG.
You think about that, $4 billion in free cash flow. If they traded 20 times free cash flow when that's up and running, that's an $80 billion company. If they traded 10 times, think about this. They traded 10 times free cash flow, which is actually not a lot when you look at where companies trade. It's a freaking $40 billion company. What is that?
So to put it in perspective, LNG, the price to earnings right now is a 5, right? It's a $42 billion, $43 billion company. So that basically is meaning that they're at $8.5 billion in net income. So if you think that you're going to get to 4 for Tellurian, what is it?
Tellurian.
I don't know, but Tellurian, then you'd easily be at a 15 to 20.
They're doing $8.5 billion in free cash flow.
Yeah. So if you do half of that, you'd be easily at a $15 to $20 billion market cap.
Yeah. On $400 million company.
Yeah.
I mean, look, it's the most speculative thing I own. It could go to 0, 100%. You know what I mean? But
a lot of capital. These things require a lot of capital. If you get them right, I mean, that's why LNG was trading at, $20,
given where
$2
where the energy market is, and given what natural gas is supposed to do, and all those things. I mean, it is super interesting as a long-term play to build a position. I mean,
let me ask a question. So why would TEL be trading at a $400 million market cap while Next is trading at over $1 billion?
Financing. People think that it's actually going to get built. People think it's not going to get built. I think, if I remember correctly, one of their major backers pulled out. They were supposed to do a 20-year deal with them for LNG. I want to say that Total, the French company, had something to do with them, but I could be wrong.
You mean
But
Next, or you mean
no, for Tel. Like, there's been a lot of bumps in the road.
Yeah, because I just saw Next. Total partnered and took like a 19% position in Next. Not necessarily Next, but Rio Grande LNG. So if that gets built out, Total's all about that. So maybe they took whatever they were going to do with Driftwood. I'll read some articles. I'm curious. I have an opportunity to probably toss some money into it. So I'll do some due diligence and figure out which one I would bank on.
Yeah, I don't know much about next decade. I mean, Sharif is the godfather of LNG. He's the chair of the board. I think that's huge for Tellurian. If they actually get this thing up and running is a different story. And I think that's the major risk is if, so.
Yeah. But in the meantime, I mostly invest in the S&P 500 and do a little spec here, spec there, but
can't go wrong with S&P over time.
Yeah. Cool. Well, I appreciate your time. Did not mean to take you an extra half hour because we were just going to do an hour. But as always, I appreciate your insights. And let me know if you're ever bored or you're wanting something to do. We do this Tuesday through Thursday. And so if you're ever just like, hey, I'm bored, let me get on Cashflow Chronicles and let's talk oil. Chris also likes oil. So
I know Chris does.
Yeah. So feel free to let us know. And then you guys could have a good debate between Tel and Next because he has a lot more information about NEXT than.
Yeah, I need to look at them more closely.
Yeah, and I'll do the same.
All right. I'll talk to you later.
Cool. Thank you, brother. Cheers.
Yep.
Good night, everyone.